All right, let's conclude chapter 8. What we're talking about now is really continuing a discussion about how do you reduce the expenses of purchasing mutual funds. Class A shares, if you remember, are front end loaded shares. You pay to purchase the shares. However, essentially what this is a volume price schedule, if you will. So the more you buy, the more you own, the less it costs to buy. So if you, let's say you had $30,000 to invest, all $30,000 would cost you 5.75% to purchase. But let's just say the next year comes along, and next year you're going to have another $30,000. So now you have a total of $60,000 to invest. So the first 50,000 are at 5.75%, and the next $10,000 would be at 475. So as you buy more and more shares, or more and more value, the cost of financing goes down. Now, we're going to talk about how you can get around these breakpoints and how you can use that, but that is essentially the idea. It is a volume discount strategy, if you will. So how can you break them? You have to have a large sum purchase. If you had 60,000 instead of 50,000, it would cost less. A letter of intent, though, says, you know, right now I only have $40,000, but I think I'll have another 10 or 20,000 over the next year. So we can agree to purchase enough within the next 13 months to exceed that break point. So we can say, well, and by the way, it's not a contractual commitment. It's just a checkbox on an application form. But it says, look, I could actually go back 90 days and maybe find other investments and get that money and include that. Or I have 13 months moving forward to get enough money to get to the next break point. Now, the other thing that's true is as you continue to invest, or as your investment grows, it will grow to values that exceed a breakpoint line. So over time you pass the breakpoints, or you could just accumulate more and more shares through purchasing, and eventually that will get you past breakpoints somewhere down the line. How do you sell shares? In the stock market, shares are sold back through a brokerage. They are either purchased by another investor or they are purchased by the brokerage house themselves. With mutual fund, the process is different. The mutual fund company has to redeem the shares within 7 days of a request. It's the mutual fund that essentially buys the shares from the old shareholder. Again, these shares are retired. The actual number, if there's a number for the share, is never sold to another investor. So what kind of services do you get with a mutual fund? One is called the reinvestment privilege. Current income and capital gains are automatically reinvested. That is, you buy more shares into the mutual fund. But what if it's a front load fund? There's no load charged for this reinvestment. So these shares are reinvested at a cheaper price than what the shares are that created them. Now, you could just take cash if you wanted it, but the default is reinvestment. So if you want the cash, you have to request the payment. Again, in an application, it's just a checkbox to tell them that you want the money. Conversion privilege says that you can move shares between the same fund family at no load. So let's say as you get a little bit older, you say, you know, I really need to move some of my money from these stock funds. I want to move some to a bond fund. So as long as it's within the same fund family, you can do that at no load. Now the IRS says, well, wait a minute, you are essentially redeeming shares and buying more. So there is a tax that you'll pay on that, unless it's in a retirement account, but there's no load that you'll pay. An additional service is something called systematic withdrawals. You can call them up and say, look, you know, let's say you have $40,000 in a mutual fund. And you say, you know, I'm thinking about buying a new car. And this new car is going to have a payment of $300 a month. Well, you can call your mutual fund company and say, look, I want you to send me $300 a month from my fund, and then when that money gets to you, of course you'll get it a couple of days before the payment's due, you'll use that money to make your car payment. Now what this allows is it allows the mutual fund to continue to grow at whatever rate it might be. If it's in a stock fund, it could be, growing quite nicely. Might be losing money as well, but it could be growing, right? So you could get a higher rate of return on the investment in the mutual fund than you get on the interest that you're paying on the car. Mutual fund companies are rated, right? Morningstar rates them. It's probably one of the best sources. It's obviously unbiased. It provides lots of information. Lipper these two are the most popular. Standard & Poor's also gives us some information. Thomas Financial it provides data and analysis of mutual funds as well. But there are rating services that rate mutual funds. All right, we're going to switch gears a little bit and talk a little bit about traditional index funds. An index fund holds shares in all the companies that make up the index, like the S&P 500. This is not really true. They rarely hold the shares of all of them. They just try to create a clone, something that's going to act just like the S&P 500. The advantages, fewer capital gains. It's going to keep pace with the selected index. It's a little bit of a more painless strategy, if you will. And there should be lower costs. The pitfalls, though, are downside risk. Of course, when the index loses money, you lose money. They don't actually copy the index, so what happens if their weighting system isn't exactly the right one? What if it's doesn't match up exactly with the index? How can different index funds have different returns, right? I mean, how can you have two S&P 500 index funds and they have different rates of return from each other? They have a narrow focus. You lose the value added by money managers. I mean, there's no thought process in calculating or buying all the stocks of the Dow Jones Industrial Average. There's only 30 of them. So you don't get any management of the funds as far as the money managers themselves. And of course, you could have increased volatility because you're investing in a stock market in general, so you're subjected to that particular market's uncertainty and volatility. The next kind of thing we want to talk about is something called a variable annuity. And a variable annuity is like an IRA that's not deductible. And we're going to talk about retirement accounts later, but an IRA is an individual retirement account that you're allowed to put money in there. It grows tax deferred, so there's no tax until you take it out. And you can take it out when you're 59 and a half for retirement. A variable annuity is the exact same thing, except you cannot deduct investments in a variable annuity from your taxes like you can a traditional IRA. The difference here is there are some guarantees that are given. It's protected by an insurance component. So there are some guarantees to funds that you'll be able to take advantage of. You get diversified portfolios. In this case, there's no limit on annual investment. In an IRA, currently the most is $5,000 a year. Upon death, beneficiaries are guaranteed the face value or the higher market value. Again, that's one of the guarantees that the insurance piece gives you. Of course, you pay for this. There is a cost. A variable annuity company might permit annual payouts without penalty, right? They may allow you to withdraw funds without giving you any penalties after, say, certainly after you're 59 and a half. But what we want to watch out for is something called annuitization. We talked about this a little bit in the life insurance chapter. But if you can avoid annuitization, you want to try to avoid annuitization. And of course, you get a tax-deferred growth of funds. What are the drawbacks? Well, there are expenses, right? It depends on the contract. Every company is different, right? The shares in the variable annuity are institutional shares, so they might not have that high of a load and they may have actually very low expenses because they're obviously a different share of class. But you do pay for higher mortality and expenses. You pay for the guarantees that you get. Most of them have contingent deferred sales charges. That's seen here as being a drawback, but in essence it means that, you know, if you buy this for long term, which is, they're all long-term investments, this is a good issue. But if you need the cash in 4 to 5 years, you know, maybe this is not the answer for you. Maybe mutual funds are not good. And again, if you need this money before you're 59 and a half, there's a challenge with having withdrawing the money. There's a penalty. So where do you get the sources of funding for this? Maybe you're liquidating some earnings from another investment. Maybe there's a withdrawal from a tax savings plan, right? You're going to move your money from a 401k. You're going to move it into another account so you can withdraw money at retirement. You receive some life insurance death benefits, other inheritances. Maybe you sell a business, right? You have a cash value life insurance that has an amount in there, and you want to convert from cash value life to term, or even another annuity you want to exchange to a 1035 exchange. You can move it into a variable annuity. So, exactly what is this, right? A variable immediate annuity is essentially, the assumption here is annuitization, right? You're going to put in some money into this variable annuity account, and you're immediately going to withdraw an annuity, right? An annuity is an equal cash flow for a certain period of time. So you'll designate what that time is. That's the process of annuitization. The problem with annuitization is you lose full control of the money. All the money now that you invested now belongs to the investment company. You're typically going to have some higher expenses than you would with a mutual fund, but you're also going to have lower returns. Why would you get lower returns? Because this investment vehicle is now going to be invested in a fixed income security. Lower rates begin because now the money, the insurance company is making a promise to pay you money for X number of years, and they want to make sure that they can do that and make a profit. The benefit here, though, is part of the income that you withdraw is not going to be taxable, right? The guaranteed income for a specific period of time, right? You might be able to get that for life. Again, that may be the thing you want. I don't necessarily see this as the ultimate guarantee or benefit that you want. Again, what's the difference between an IRA and a non-qualified annuity? Again, you can contributions, right? You can put a lot of money into their after-tax dollars, so you can put that both. Earnings accumulated, tax deferred in both. Earnings are taxed on withdrawal. That's for both. Principal can be withdrawn tax-free. That's true. There's a 10% penalty that applies to withdrawals before that. That's true. So what's the difference? These two things are, the second one I think is a little bit more important than the first thing, but in an IRA, you are required to start taking minimum distributions at age 70 and a half. Well, what if you don't need the money? If it's in an IRA, you still have to make required minimum distributions. There's a formula, calculation. They'll tell you how much you must take. In an annuity, you don't ever have to take the money out. It can actually pass through your estate to the beneficiary of the annuity. Unlimited payments to the contract. Of course, in a non-qualified IRA, you're limited by the amounts that are designated by an IRA. Currently, $5,000. But you can put an unlimited amount of money into a variable annuity. So there are definitely some differences, benefits, I think, over a non-qualified annuity versus a non-deductible IRA. So who would an annuity be good for? You have to have long-term savings. Maybe you've maximized your retirement accounts. You want family protection in the form of a death benefit. You want to grow assets tax deferred. You want to be able to move amongst funding options. You want to do that tax free. Maybe you want lifetime income, right? You've received an unexpected lump sum. Liquidity is now a key determinant on whether variable annuity contracts can even be offered, right? This is a big change in regulation over the last couple of years. There were a number of instances where unscrupulous marketers were selling variable annuities to people that shouldn't have variable annuities. They were people that had essentially no other money other than this. So what they do is they put in this. Of course, now it's locked up, and if they do need the money, they have to pay the contingent deferred sales charge. So again, liquidity is a key tool. If you don't have liquid assets, you might not be able to pay. You may not be able to even buy a variable annuity. Who might a variable annuity not be worth? Somebody that has net worth less than $100.